Today, we discuss how the banking industry may change over the next few years. Well, good morning. I'm off out this morning to go to a conference in Sydney, and that conference is customer-owned banking organisations in Australia. I think it's quite an interesting area to be involved in, seeing as there are quite a few small players who really haven't made much mark on the market over the last few years. The market has been very much dominated by the big four players and then the regionals. But this customer-owned sector, which includes credit unions and building societies, actually have a very significant opportunity, I think, given the current environment, not least all the flack from the Royal Commission, which will continue to question the trust of the major banks. And it gives an opportunity potentially for some of the smaller organisations to step up. But of course the question is, how should they do that? Given the fact they've got a very small footprint, given the fact that potentially they have really not a strong profit motive, which is probably a good thing, by the way, and their product range is probably a little more limited than the big guys. However, what is interesting is if you look at some of the rates that they offer, some of their mortgage rates are significantly better than the big players. So I think this will be an interesting day. I'll try and give you an update as we go through the day. I'm not quite sure how much I'll be able to record, but it'll be an interesting day looking specifically at the customer-owned banking organisations and the propositions that they may develop. I'll be talking specifically about three things. Firstly, about digital innovation and how that can play in. Secondly, the impact of the Royal Commission and all of the other things that have been done relatively recently from an inquiry point of view, and what the opportunities might be from the back of that. And then thirdly, more generally talking about trust and how customer trust and consumer trust needs to be re-established. So I'll catch up with you a little bit later, once I'm on the train perhaps, or when I'm in Sydney.
The train on platform 1 goes to Central. First stop, Helensburgh, then Sutherland, Hurstville, Walleye Creek. On platform 1 goes to Central. First stop, Helensburgh.
Okay, so I'm here at Darling Harbour and just about to go into the session. It's pretty breezy today actually, and the weather isn't very kind, it's raining. It's always great to come back to Sydney and see all the sights. I reckon it's even busier than it used to be, so I probably come up here 4 or 5 times a year, and every time I reckon there are more people. I'll check back with you a bit later. Good morning, Gareth. Well, yeah, we knew this had to come because essentially the banks get some of their funding from the capital markets, and the recent moves in the capital markets have been up a little bit. So essentially what we've got is now them trying to work out how to balance discounting deeply to attract new customers with funding the back book, as it's called, in other words, all the existing loans. And so what we have seen is this sort of weird move where effectively the overall rates are going up, but then there are very, very cheap attractor rates to offset it to try and capture new business. So it's not a straightforward situation. And it's worth just remembering that the Productivity Commission report, which came out very recently, and the ACCC report both highlighted the fact that actually a lot of this stuff is not really to do with competition, it's to do with the sort of the way that the market is working, and it doesn't really work for customers. So I think this is another example. Yeah, so there's a difference between, if you like, your legacy rate. So if you've got a rate that's 2 or 3 years old, it'll be a lot higher than if you went and knocked on the door of the bank today and say, give me a refinanced mortgage. That's if you're of a good credit standing and everything else, right? So effectively they've got this war chest because they all put their rates up last year and blamed the regulators for that. Although of course now the ACCC is saying, well, that was not that simple. In fact, there were more things to do with buttressing profitability and anything else actually. Yeah, so if you've got an old loan, you'll be paying more, but also then if you don't actively manage your mortgage, then it's going to tend to drift up over time. Now, this is then before the next round of lifts, and they will come from 2 sources. The first source is from the overseas environment, because the US is going to put its rate up by 25 basis points tonight, probably, and people are saying another 3 or 4 lifts this year. We've got similar signs in Europe there as well. So internationally rates are going up, and that's going to flow through to Australia. And then of course the other question is, what will the Reserve Bank do? Because rates are sitting at 1.5%, ultra low, ultra low. But what it means is that we have got households with very large mortgages and no wriggle room, and any slight movement, be it from overseas or be it from local, will have a profound impact on households. Yeah, so essentially the cash rate is not really that connected to mortgage rates. It used to be years ago, so every time the Reserve Bank moved, the mortgage rate would go up or down, but recently that's not the case. And that's partly because a lot of the large banks particularly fund a proportion of their book from the international capital market. So effectively they're issuing bonds overseas and essentially funding their books from that. So whatever happens in the capital markets flows through to the cost of funds for the banks. They then have to try and recover those costs of funds. And as I say, the problem they've got is that lending momentum is much more slack than it used to be. It's slowing quite dramatically, particularly because investors are sort of voting with their feet and not transacting. So these banks are struggling on one hand to try and manage the cost of funds, which are going up, but also trying to attract new customers in to grow their book. So they're really caught, and you know, it's a real tussle between rates going up, rates going down. Well, let's answer the second question first. So our mortgage stress, which is based on our household surveys, looks at how household cash flows are. In other words, money coming in, money going out. There's 925,000 households across the country now, which is about a third of those borrowing for an occupation, who have difficulty meeting those mortgage repayments now at very low levels. If the rates went up by, let's say, 1%, that would then move up to well over the 1 million households. So there's a significant risk if rates go up. Now, probability of rates going up, I think from the Reserve Bank, very low over the next few months, but I think the international wave, if you like, of rate rises will flow into Australia. And bear in mind that we've got a situation where incomes are flat and static in real terms and cost of living are going up. So even if rates didn't move at all, households will continue to struggle for some time unless we see significant rises in incomes, and I can't see where that's coming from. And effectively, if you overlay then potential interest rates over the top of that as well, then it just makes the situation significantly worse for many households. And you know, the other interesting point that's worth noting is that lenders today, if you went in and asked for the same loan as you got previously, they'll probably give you about 20% less because they've now tightened their underwriting standards as well. So we have a lot of households with very big loans when lending was very loose. And you know, the Royal Commission highlighted this over the last few days. It's now much tighter, and that means we know we've got many households who are really stretched. Yeah, I think it's a perfect storm of if you look at all the various elements. So we've got this interest rate thing going on. We've got very high debt. Household debt in Australia is higher than almost anywhere in the Western world. It's been growing, and frankly will continue to grow because lending is still growing faster than incomes. The other point to make is that home prices are beginning to slip. So we're now seeing people beginning to get worried about whether in fact prices will continue to rise. And if not, then that means that effectively you might end up with a property that's worth less than you thought it was. So we've got all of these things. So I'm projecting over the next 12 to 18 months, we could see prices slide 10 to 15%. And I'm thinking that interest rates could be up 0.5% or so over the next year or so. So, you know, together, these things are very troublesome. What I would say about it is that if people have issues, they should do their cash flows. About half of households don't have a cash flow, so they don't actually know what they're spending and what they're receiving. It's amazing what you find when you actually do the work on that. So, you know, start now, think about it. And then the other point, of course, is that if you are in difficulty, talk to your bank early because they do have an obligation to assist. But it's really important that people are sensitive to these issues and plan accordingly. We're not going to see rates going down any further, I don't think, and we're not going to see home prices rising. So effectively, plan for the unexpected. Well, I've always said that you should assume interest rates will rise 3% higher than where they currently are. That would be a typical long-term average rate. And so do the calculations on what it would be. And look, here's the point. The bank may well say you can afford the loan, but you need to do the calculations yourself because they may not have all the information, they may not use the same estimates. And of course, again, the Royal Commission's highlighted that in some cases they haven't really done the work properly. So 3% I think is a good indicator. And you know, if you do a 3% on the size of your mortgage and think about the repayments, that's a lot of money, a lot of extra money every month. Well, some people are definitely paying ahead, so that's, you know, the good news is that some people have a cushion, some people have paid ahead. The trouble is that the households in mortgage stress that we've been talking about are precisely those who have not been paying ahead and often will have other debts as well. So they'll have credit card debts and even in some cases payday loans. So we have to look at debt holistically. I think it's important people have a strategy around their debt and how they actually begin to think about managing it. Don't put your head in the sand, don't just assume it'll all be right, because it won't. You need to actively manage it. Okay, so I've just done an interview on the run, as it were, with 6PR in Perth, talking specifically about interest rates and all those related items. I think it was quite an interesting discussion. We quite often have these sorts of calls on the run. I also had another call this morning from the Brisbane area from Channel 9, who was also interested in looking at the mortgage stress stuff. So it's all very interesting. Right, I'm now going into the conference. Talk to you later. Hello, good, okay. Yeah, I think it's a continuing process, but the speed of momentum is remarkably faster than it used to be. And if I sort of call out 3 or 4 fundamental things that I think are worth thinking about, the first is digitalization, and that's from a consumer perspective. In other words, people want to do more using this than effectively going into a branch. And all my research says over the next 4 to 5 years, the branches really become pretty obsolete, frankly, because essentially the only people who are using the branches are older people, less profitable people, and ultimately, in the future, branches will become less important. So digital is really critical. It's also critical from a service delivery perspective because you can do way new things. Small organizations can look really big, and so suddenly it changes the branding. The second point I'd make is that the competitive landscape is fundamentally changing. And if you look at the 21 or 22 or 23 different reviews and commissions, all those things, right? What's clear is that the old doctrine of financial stability at all costs is now being turned around to being customer first. Now, it's a long journey, we aren't there yet, but there's a real opportunity based on thinking about it from a customer perspective. And the way I think about it is the large big players, the ones who are, you always think about. It's a bit like the Monty Python film there, where you've chopped his arm on, chopped his second arm, his first leg, but it's only a flesh wound. No, this is much more serious, what's going on now. Creates huge opportunity, I think, for smaller organisations, nimble organisations, but you have to do things differently. You can't just do what those guys have done, and you wouldn't want to based on what the Royal Commission actually surfaced. And then the third point I'd make is that think about it from the customer and think about it holistically from the customer, because actually what customers want is not products. They want advocacy, they want advice, they want help to navigate this financial world that they are part of. So put those things together, boy, there's an opportunity. Okay, let me add another point, and that is that the big banks have consistently said that we are in a very, very competitive environment. And at one level, they're sort of right, insofar that they're all fighting each other, and if you look at the way they set their rates, they're all look at each other's and then set the rate. But that's not real competition at all, right? That's actually just a set of behaviours designed to protect themselves, right? If we really want to turn this around, and we can turn it around, to think about from a consumer perspective and what's right for the consumer, actually everybody wins, because all the research around the world says that in that environment, if you are doing the right thing for your customers, actually you get more share, you get more credit, and you get bigger brand recognition, right? So the idea that you can't do the right thing for your customer because of commercial reasons or because of system reasons or whatever is just rubbish, right? There's a real critical, at its heart, financial services is about customers and about providing them with the products and services that help them to live their lives better, right? That's the value proposition, and I think that's perhaps where we're going to head, but it's not going to be a straightforward route, because a number of large players have huge things to lose in the journey, right? And as you saw in the Royal Commission over the last 2 or 3 days, they don't get it yet. They don't understand the cultural norms that are required to do this right. You do, I think. So that gives you an opportunity. And sorry, let me add one other thing. Consumer education is absolutely critical here, right? It amazes me that only half of the households that I survey, 52,000 each year, have any sort of idea as to what they're spending and what income they've actually got. So they have no cash flow, they don't know how to do it, right? And if you look at that, it's not that it's just an older generation and all the younger ones are fine. It's across the generations. We have a fundamental problem here that people actually are either scared of finance because they don't understand it, or they think that it's all the same and there's no point in going over there or over there, right? Because everybody's the same. So one of the messages for you guys, I think, is to differentiate, right? Demonstrate how different you are, you know, the culture that you have. That's really important. The other point I'd make is a political question. Is either side of politics really interested in better consumer outcomes? Because I don't think they are. I really don't think they are. I think they pay lip service to this. The fundamental point, I would say, is that generally people are relatively okay in the political circles with the status quo. They'll do a little bit round the margin so they look as though they're doing things. But the fundamental radical reform that we really need, I'm not sure it's going to come from political circles. I think it's got to come from communities and individuals and lobby groups, because there is a huge penalty on Australia for the inefficiency in our financial services. It's like a tax on everybody, right? If we got this sorted, not only would consumers have a better outcome, but actually we'd be spending less of our GDP on it, and you could put it into other things that would actually be better. Shall I have a go first? Yeah, so this concept of trust is really, really important, because the fundamental point is there that it was always an assumed property of organisations. So people assume that you could trust them, right? That's no longer true. So again, in my surveys, the same messages come up. We don't trust anybody. We don't actually trust, you know, not just banks, but it's broader than that. So this is a fundamental cultural issue for us as a country, I think. And to be honest, some of the behaviour even in the political sphere over the last 10 or 15 years hasn't been very helpful, to say nothing of you know, the commercial sphere as well. The other point I think is worth thinking about is on the digital side. Here, we don't rate very highly on digital, but it's not the digital penetration. We're one of the highest, most digitally enabled countries in the world, so we're right at the top on that part of the scale, but it's very marked, very low on what we're actually delivering. So the value propositions that we're actually delivering digitally at the moment are actually not very good ones. We've tended to sort of just pave the cow paths and just do the same things as we always did, right? Rather than actually think about those new things that we can do. So my belief is that you can begin to turn the trust story around by doing different things and doing different things digitally. And if you do that, you have the potential then to become distinctive and different and build trust from there. But it's a long, long journey. It ain't going to happen quickly. I'll give you one really interesting example, right? It amazes me how many people sit on legacy deposit accounts. And over time, a lot of organisations atrophy those rates. So effectively, the rates for new savers are actually always higher, right? If you were going to actually come at this from a customer focused perspective, you'd be out there making a proactive approach to the customer, saying, did you realise that you can get a better deposit rate? Or did you realise that you can get a better interest rate on your mortgage? Now, if you started doing that, that would really swing the pendulum. And again, make the point, digital allows you to do that, right? You could actually do those sorts of things. And for me, those are the differentiating offers that can be created now that couldn't have been created then. So I don't think you want to follow the big guys down their cul-de-sac, right? You want to carve your own path. But that means thinking differently about your business model, thinking differently about the way that you interact with your consumers, and be proactive. It's really interesting to say, can leopards change their spots, right? The endemic behaviours that we've seen across our larger organisations, it's not just here in Australia, by the way, it's around the world, is a set of corporate values that actually spills over not just from financial services but more broadly, right? So this is a really deep cultural thing we're talking about here. It's about the way that corporates work and what are the cultural imperatives that are driving it. If they were to start to get their act together and really make the change that they should, and they know they could if they really wanted to, yeah, you'd have a really big challenge on your hands. But I wouldn't hold your breath, because I think the job that they've got is turning the Titanic in the middle of a storm with the icebergs and no jet jets. I'll go first on that. Let's face it, over the last 5 or 6 years, everybody has actually done the same thing, which is effectively to lift the rates on the back book and then discount deeply to get new business, right? That's the fundamental model that's been around. I think to change that is going to be really tough. But if you start with the value proposition about having a long-term relationship with a customer rather than just a transaction, be it a mortgage or whatever it is, you've got a chance of having a different set of conversations. So I'm going to be positive and say my crystal ball is telling me that we will stop seeing this stupid rate cutting right at the front to try and just drive growth, because I think the growth in lending is going to go backwards. I think we're going to see lending volumes considerably down, in line with home prices, but that's another story. So it becomes much more a question of managing the relationships and the business that you've got, rather than trying to acquire new business at the front end and letting all the business drop off the back of the lorry, right? So this is about retention. This is about building long-term relationships with your customers rather than just a transaction around a home loan or a credit card. That's what I hope and what I think, if you know, with a following wind, that's where we could end up. So it's simple. Customer advocacy is what we're talking about here, right? So being on the side of the customer, right? Helping them with their issues. So you build trust one brick at a time around advocacy. I think trying to solve the big picture macroeconomic thing is, you know, you can't do that. But what you can do is make a difference with those relationships with those customers that you have, and do the right thing by those customers and become their advocates and become trusted. Then you start expanding trust out from there. So I would say you can't legislate trust. You can't put regulation in to try and replace trust, right? So effectively, all of the stuff that we've got, and we've got this pillar on pillar on pillar of regulation, is a proxy for trying to solve a much deeper problem, right? It's time perhaps to change our way of thinking because otherwise we'll all be lawyered out, right? And there'll be just ever more rules and regulations and paperwork, right? It gets in the way of doing the right thing. But if we get on the right basis with the right set of values to start the conversation, there's a chance we can actually win. The short answer is there has to be, and there always is to some extent. It's about the degree of cross-subsidisation, I suspect. The idea of being able to surgically allocate cost X over there, cost Y over there, cost Z over there is stupid, because you can't, right? I can make the cost of a mortgage broker twice the cost or half the cost, depending on how I actually allocate costs. So the whole idea of actually peeling the onion back and trying to put every little bit of cost back the right place, that's not ever going to work, right? And I think that if you go back to the point that there is a social obligation underpinning what we're at, right? And around that, there's some economics that needs to work. I think that's a really good place to start. I don't think that spending more and more time trying to get more and more granular and then to remove more and more cross-subsidisation is actually going to be very helpful.
Together for the thank you to Aaron, Andrew, and Mark. Really appreciate it.
Thanks. Well, I'm back in the local town, having taken the train back down out of Sydney. The conference was very interesting, had some interesting discussions. I've included in this particular video a few extracts from the sessions. Didn't include all of it because I only used my material because I wasn't allowed to record the broader proceedings. Anyway, my conclusion, for what it's worth, is that there is an opportunity for the COBAs, but also they've got a long way to go to be able to capitalise on that opportunity, in my view. And it's been raining absolutely all day. Every time I step outside, I get wet. So that's going to continue, I think, as we cross the road here. So there were a few takeouts, I think, from today's session. The first is there's quite a number of these smaller financial services organisations who are actually quite aligned to their customers. But they're also struggling in the context of the broader financial services sector, because in a way they have to compete with the big guys who, as we saw from the Royal Commission, have essentially got a whole bunch of agendas other than exceeding customer expectations. And so the core challenge that I see for them is, do they play the same game as the big guys, or do they chart their own separate path? Now that's not as simple or straightforward as it may sound, because doing something different requires the capital to do it, it requires the capability to do it, and it requires the intent to do it. And that, I think, is the key challenge. I guess the good news is that the Royal Commission and the other regulatory reviews that are going on at the moment may collectively provide some extra impetus for change, but I think that change has to come from customers rather than from looking to regulators or indeed the big guys to clean up their act. So I guess my message and my conclusion from today is there is an opportunity for customers to vote with their feet. Look at some of the smaller players who, by the way, quite often have better interest rates and a more powerful value proposition relative to the big guys. The problem is that many people don't know about these smaller organisations and believe that all banks are the same. Well, the good news is there are choices out there, but you've got to go find them, because I don't think in the current environment they will necessarily come to find you. So if you found this useful, please do like the post, and if you haven't subscribed yet, please do so to receive future updates. I'm going to battle up the hill now, dodging the rain and the wind, and I'll catch you next time. It's Martin North from Digital Finance Analytics.